By the late 1980s, warning signs were everywhere, but speculation had replaced rationality. Everyone believed the boom would continue forever. The Bank of Japan kept printing money and handing out loans to anyone who asked, regardless of creditworthiness or what the money was for. Asset prices detached completely from reality. Then, in 1990, the bubble burst. Throughout that year, the stock market crashed by 43%. The Nikkei 225, which had peaked at nearly 39,000 points on December 29, 1989, plummeted to below 15,000 by August 1992. Real estate prices followed in a downward spiral that would last for decades. By 2004, prime commercial properties in Tokyo had fallen to less than 1% of their peak values. But the crash itself wasn't the real catastrophe. Economic bubbles burst. It happens. What made Japan's collapse uniquely devastating was what came next. The revelation that the entire system was rotten. Corruption was everywhere. Insider trading, stock manipulation, bribery, fraud. It permeated every level of Japanese business and government. The supposedly efficient Keiretsu system had created hundreds of zombie companies, businesses that should have failed years ago but kept surviving on an endless supply of cheap government loans. Banks, terrified of recognizing their bad debts, kept these corpses alive with evergreen loans, creating a stagnant corporate sector unable to hire new workers or innovate. Within a decade, Japan went from being called an economic tiger, riding the Japanese miracle, to being labeled the sick man of Asia. Economic downturns happened to every country, but what made Japan's crisis unique and what created the lost generation was the catastrophic collision between economic disaster and Japan's uniquely rigid employment system.